Good afternoon and welcome this afternoon to another great webcast from Schwab Coaching. We're talking short verticals today. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat by my good friend, Brent Moores. And we seem to be going back and forth today and yesterday in a bunch of chats and webcasts, which is great. We're glad to have all of you here, whether you're in the live version or whether you're in the recorded version. Thank you for joining us. We appreciate you being here. Brent's going to be out there helping to answer your questions along the way. He is a 20-plus year veteran of the financial markets and well-versed in all of these topics that we're going to be talking about, well-versed to help answer your questions. You can follow me on X at Ben Watson CS. You can follow Brent on X at Brent Moores CS. We'd love to have you join us there for more content. Hey, so today I have kind of the really unique opportunity to have kind of a Joni Mitchell moment and look at vertical spreads from both sides. Now, we talked about earlier today in the long verticals and diagonals webcast, we talked about long vertical spreads. So today, I thought, this afternoon, in this webcast, I thought we'd talk about the same vertical spreads, just on the other side of the coin. So we'll look at vertical spreads from both sides, and we'll see what we get to in this discussion. So thanks for joining me. Whether you're here in the live version or the recorded version, participate in the chat. Make sure that your chat's set to live chat so that you don't miss any of the conversation that's going on. And we've just got a couple of quick housekeeping items that we need to take care of here. Really quickly, remember that everything we're going to talk about simply for illustrative and educational purposes only. It is not a recommendation or endorsement of any particular security pattern or strategy. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before you consider any option strategy. Remember that multiple leg option strategy will involve multiple commissions and transaction costs. Also remember that spread trades in most cases must be done in a margin account. Also, we're going to be using the Thinkorswim desktop software platform today. It is not a guarantee of future success out there in the real world. However, the paper money version, which is what we're going to be focusing on, is a great learning environment. So recognize, however, that when you move from paper money to live trading, there are some things that are a little bit different. Paper money does not facilitate the early assignment of short options. And when we talk about short vertical spreads, that is one of the things that we want to be aware of, that possibility that any time that we are short an option, that option could be assigned to us. Now, there are times when that's more or less likely to occur, but just recognize that there is that possibility for that scenario to occur. Now, we're going to talk potentially about rolling options as well. Remember that rolling is not a magic wand. It is simply a convenience tool for allowing the trade to be extended or adjusted in one convenient order. It doesn't reduce the transaction cost, and it depends on the liquidity in the target strike or expiration. Also, remember that investing involves risk, including loss of principal. And there are a lot of different ways to look at the market. All of them are theoretical in nature. None of them are guarantees. And past performance of any security or strategy doesn't guarantee future results or success. We will probably not talk about stops, but it's always a good reminder to hear that when we talk about stop orders are not a guarantee of the execution price. Just simply give us the opportunity to set the trigger price or the activation price. In the event of a stop limit order, that order could get gapped around and the order could not fill at all. So let's jump out into our Thinkorswim desktop software platform here really quickly. And as we do that, this is a good opportunity for me to remind you to click on the subscribe button down at the bottom of the page. Also, the like button as well. If you find something in this webcast that you like, that's going to help. Both of those things are going to help in a couple of different ways. If you click on the subscribe button, that's going to help you find this content more easily. It's also going to allow you to set alerts. It's also going to help other people find the content. If you click on the like button, it's going to let us know that you liked the webcast, and it's going to pop this content up to the top of the algorithm. That's going to allow others to find this content and share what we feel is a great resource for those that might be learning how to trade or extending their skill set or learning about opportunities. And by doing that, it's at no cost to you. That helps us out. It helps you out. And we appreciate that along the way as well. Okay, so let's take a quick look, because now we've got kind of the middle to the end of the day kind of coming at us here really quickly. A couple of things have changed. One, we've seen some news on tariffs over the course of the day. Two, we have the uncertainty about who's going to be the next pope. That has been resolved, so that maybe eases the market's mind a little bit as well. I don't know if it does or not, but the market has gone from a little bit of a gap up and sell off earlier today in the SPX to a little bit of a gap up and a rally, getting closer to that 200 period moving average. At this point, the NASDAQ testing at or above that 200 period moving average, so maybe gaining a little bit of strength there in terms of that upside movement. And the Russell 2000 definitely seeing a little bit stronger move to the upside off of the 50 period moving average as a support level, off of this horizontal level at the 1993. So definitely some stronger upside potential, at least initially. If we take a look at the volatility scenario, let's take a look at our VIX grid really quickly. And volatility, which was starting to move up a little bit earlier today, just after the market opened, we're starting to see volatility kind of extending itself to the upside. That volatility is kind of bleeding off a little bit. Now, one of the reasons why this is important to pay attention to is because this overall volatility, with the market moving higher, that volatility moving lower, would be a situation that would be beneficial for short vertical spreads, as opposed to, say, for instance, long vertical spreads. Now, a long vertical spread is one in which the option that we are purchasing, the one that we are long, is the driver of the trade. And a long option benefits from rising implied volatility, whether it's a call or a put. But in this particular case, when implied volatility is falling, that works in our favor in the event of a short option, meaning we sell an option, we sell it when it's expensive, we want to buy it back when it's cheap. We sell a spread when it's expensive, and we want to buy that spread back when it's cheap. Falling implied volatility is going to benefit us in that sense. So there's a couple of things that we might think about as we put some trade examples together here and some of these ideas together, that a short vertical spread is going to benefit from falling implied volatility. We're at a level where implied volatility has been, still is, relatively elevated, even though it's come down a little bit. We now have a little bit of a crack in this kind of 22, 23 level, where maybe implied volatility is coming down just a little bit as we see, again, some of that volatility bleeding out of these options. So we talked earlier today in the long vertical spread webcast about rising implied volatility being a benefit. Here in this short vertical spread, we're going to talk about falling implied volatility being a benefit. So what I'm going to do here is I'm going to come over to my monitor tab. Now that we kind of have a sense of what's going on in the market, we've got our kind of roadmap, or at least our market posture, if you will, at the moment seems to be short-term bullish. I'm going to come over to my monitor tab in the thinkorswim platform, and we'll talk about a couple of the trades that we put on earlier today in the long vertical webcast that we're now going to replicate in the short vertical webcast. So I don't know about you. I don't know if you've ever asked the question, should I choose a long vertical spread or a short vertical spread? If you've ever asked that question, this is going to be a conversation that you're going to want to have, right? This is going to be a discussion that hopefully will be of interest to you. So let's take a look at a couple of examples here. The first one we're going to look at is Delta Airlines. So on Delta, we created a long vertical spread that was expectant of upward movement in the price of the stock, right? We expected, let's go to the chart here on Delta, DAL. We expected that the price of the stock was moving from where it is now to where it's likely to go, not guaranteed by any means, but our expectation is that the price of the stock would go to 50. So we created a vertical spread, a long haul vertical spread, that would benefit if the price of the stock went from where it is up to $50 a share. That would get us to theoretical maximum gain in the trade, but we might have to wait a little bit. We might have to be a little bit more patient in that scenario because it might take a little while for that time decay to eat away at whatever extrinsic value is there. Now, if we were going to create a short vertical to accomplish the same purpose, right? To accomplish the same purpose, our directional bias here in this particular case is bullish. We expect that the price of the stock is going to go up. We wouldn't create necessarily just a short call vertical. We created a long call vertical, but in order to take advantage of the bullish nature that we're seeing in the stock, we're going to create a short put vertical. So the directional analog, if our directional bias is this, let me bring my annotation tool out here and we'll kind of walk through this. If our directional bias is up, then a long call vertical is bullishly biased, and at the same time, a short put vertical is directionally biased in the same direction, right? So these two are analogs of one another. Long call vertical, we buy. Short call vertical, we sell. So the objective is a little bit different. The long call vertical, we want that both of those legs to be in the money at expiration. The short put vertical, we want both of those legs to be out of the money at expiration or expire worthless, or we buy it back very close to expiration and it becomes worthless, or we buy it back for as little as possible, right? So the directional analog here, long call vertical, short put vertical. So we did a long call vertical this morning. Let's look at this vertical from the other side now, and let's build a short put vertical. And if our intent is for both of these legs to be out of the money, both the put legs in our short put vertical to be out of the money at expiration, what's going to help to determine that and the probability of that happening is where we position our strike prices and the amount of time that we give this trade to move. So we're going to go to the trade tab. Now, when we're the seller of an option generally, we want to be on kind of the shorter end of the perspective from a time perspective, because time decay is generally going to work faster the closer we are to expiration. And so we're going to kind of take a shorter approach to this. We're going to actually go in a little bit here to maybe the 30th of May. Now, when we put together our Delta Airlines long call vertical, we went to the 13th of June. I'm going to come in a little bit. I'm going to come in about 15 days or so from that to the 30 May expiration. And I'm going to make this back to single options. And so now we're going to create a short put vertical spread that is likely to be out of the money at expiration. So one of the things that we might think about from a strike selection standpoint in putting this trade together is where the price of the stock is, where we think it's going, and where it's been before, right? So once we've broken out of this area here, this 45 level, that area, which was resistance, now becomes what? Support, right? Old resistance potentially becomes new support. So if we sell our short put vertical spread at or below a level of support, then that support could potentially act as a barrier or challenge to the price of the stock coming back down. It doesn't mean that it's impervious. It doesn't mean that that has to stop the price of the stock. It just means that that's a level where the price of the stock we might expect would find and bounce and move higher. So we're going to look at selling somewhere under this 45 strike. That's our level of support. Stock's currently trading at 48, so we go back to the trade tab. We say, all right, let's use 45 as kind of our level here. Now, I have open interest and volume in here just to show you, yeah, these are relatively liquid contracts. I'm not too terribly worried about this open interest and volume because I don't have any that have zero open interest, number one. And number two, if I'm just trading a single contract, if I'm a single contract, even with an open interest of 44 or 37 contracts there's other people in the market, right? So the concept might be trade where the people are, right? Not trying to find odd contracts out here or odd stocks where there aren't a lot of people trading it because we've discovered a gem or diamond in the rough, right? Okay. So Zanzen, that's what we're getting to entirely here, right? The long call, the conditions that existed before was that the price of the stock was moving higher, but implied volatility was also moving higher. Now, implied volatility is moving a little bit lower and the market is definitely moving higher. So we were looking at taking advantage and building the long call vertical spread with the benefit of a rising implied volatility. Now we're looking at using the short call vertical spread to do exactly the same thing directionally, just with the potential for implied volatility to fall. So you're absolutely right on with that question. I'm going to change my layout here to delta, theta, and vega. Okay, so now we're seeing delta, theta, and vega. So I go to the 45 strike. That's got about a 27-cent delta. If you remember, delta is kind of the proxy, an approximation for the probability of that strike being in the money at expiration. And what did I say at the very beginning? Was the reason why the way that we want this trade to end up. We want both legs of our short put vertical spread to end up out of the money at expiration. So I want an option that is less probable of being in the money at expiration. I want a lower delta in this particular case, lower probability that this is going to be in the money at expiration. So I'm going to this 45 strike, and we're going to look at selling the 45 strike. And then to create the trade, I'm going to go 45, and I might even go down to the 40. I might make it 5 wide. I might make it 3 wide here. You know what? In this particular case, I'm going to make it 5 wide. 45-40 is what we're going to look at in terms of creating this trade. So 45 strike, we have the obligation to take delivery of the stock at 45. The 40 strike, we have the right to sell the stock to somebody else. So we're going to create this trade, and I'm going to do this using my control key. So I'm going to do one leg at a time. I'm going to simply left click on the bid price for the 45. And then I'm going to come back, and I'm holding the control key down on my keyboard. I'm going to left click on the 40 strike ask price. And now I've created my vertical spread, right? So first of all, notice that there is a survey, a feedback survey out there in the chat. Do me a favor, help us out, help us to make these sessions better. Click on that feedback survey, set it aside so that you can come back and you can fill it out at a later time, once we're done with the webcast. If you don't do that, you run the risk of filling out the survey. That's number one. Number two, Danny from Cali asks a question. Why wouldn't you just use the probability of out of the money column? You could. You absolutely could. But delta's just kind of a quick shortcut to get to that. It's not an absolute positive 100% analog, but it's very, very closely correlated to that probability of out of the money column. So you can certainly put that on there. Absolutely. Yeah, you're right. I do have 2 on that one. So I'm going to reduce the number on this one, right? So we've got 1 and 1. Thanks, Josh, for catching that. Good catch. We would have caught that as we read through it, but notice what our credit is here in this trade, 83 cents against a $5 wide vertical spread. But this is a high probability gain in the trade, right? This is a high probability gain in the trade. So I'm going to click on confirm and send. We have the potential to make $83 in the trade. We have the potential to lose in the trade $417, okay? That is the $5 wide vertical spread minus the premium we bring in. That gets us to our maximum loss in the trade. Maximum profit is the premium that we bring in to begin with. So the hit to our buying power, the cost to initiate the trade, we're bringing in the credit to begin with, but it is going to be a hit to our buying power because it is tying up that possibility of having to take that theoretical maximum loss in the trade. So here's what we're going to do. I'm going to come back down here to edit, and we're going to take this over to the Analyze tab. And so I'm going to right click on this one, and I'm going to click on Analyze Trade. So I'm going to take out this delta that long option trade that I've got. And we're going to look at this vertical spread. So this is our short call, or excuse me, our short put vertical spread. And I don't know why I'm seeing, let's see, let's do this. Let's go show all. Let's go hide positions. So all we're looking at is this one. Oh, I know why it is. I've got to float my Y scale back. I was doing some risk profile graphs earlier. So here's our short put vertical spread. Okay. So Frankie asks the question, in terms of customizing this spread, why not do a 45-44? Why not do a one strike wide and then do 5 contracts to the spread? You could do that. Absolutely. So I want to build this so that we have kind of an analog to that long vertical spread, and then we can talk about the variations. So you can do whatever you want. I mean, I'm not saying that you have to go 5 strikes wide, 5 points wide on this vertical spread by any means. You can do whatever you want in this case. So here's our short put vertical spread. Our expectation is once again that the price of the stock goes up. Let's set our break-even price. Our expiration is the 30th of May, so I'm going to put my probability range right there on the 30th of May. You can see that the probability area, that one standard deviation range, that's that lighter gray area where we expect the price of the stock to be within one standard deviation, falls firmly, squarely in the upside of this trade. So it's a highly probable trade simply from that standpoint. And then we set our break-even point, break-even at expiration. Where's our break-even at expiration? Well, the price of the stock is already here. Our break-even is well down here. We're already above our break-even point, right? Okay. And I just did that right here, right? So 531, our expiration is 530. So we just adjusted that, okay? And the risk to return ratio doesn't look great, but then you start to talk about probabilities, right? What's the probability of success in this particular trade? Well, it's the converse of that 24% probability of the option of the short leg, the 45 strike, being out of the money, right? So if we've got about a 25% probability that option is going to be out of the money or in the money at expiration, that means we've got about a 75% probability of that option being out of the money at expiration. So about a 75% probability that this trade is successful. Now, that's not guaranteed, number one. That's absolutely theoretical, and news can change everything, right? But as we look at this, short vertical spreads, and I'll address kind of this general question to begin with. Short vertical spreads are not high ROR trades. They are not doubles and triples, if you were thinking about it in terms of a baseball metaphor. They are singles. These are small gains, high probability gains, right? And the thing about this particular trade is, let's kind of go through this short vertical and kind of talk a little bit about the conversation about a short vertical spread. Where does this get to maximum theoretical gain? Well, if the price of the stock is at or above this 45 strike, right? So anything way up here is maximum theoretical gain, and that works in our favor. Anything above our break even, in fact, is a gain in the trade. So you notice that here's where the price of the stock is already, right here. So we're already in that particular point. If the price of the stock just stayed where it was, if the price of the stock didn't do anything at all, if it just stayed exactly where it was, and we just carried this trade all the way through expiration, we would see our maximum theoretical gain. So we think about the context of this trade. Stock going up a lot, we get to that position. That works in our favor. The stock going up a little bit works in our favor. The stock doing nothing at all works in our favor. What if the price of the stock comes back just a little bit down to this break-even point? That means we can be wrong directionally. The stock can go against us directionally to a certain extent, and we still don't lose money in the trade, or we make a little bit of money in the trade. So we can be wrong and still make money, or we can be wronger and not make any money, but not take a loss. When we start to take a loss, in this particular case, is if the price of the stock moves down here. So anywhere below our break even, we're now starting to take a loss in the trade, right? So that becomes the characteristic of this short call vertical spread. So let me address a couple of the questions in this particular case, because there are a lot of them, and you guys are starting to do the what if, which is great. Ambrose asks the question, well, a June expiration offers more credit. Why the May expiration? Because this is a time issue too, right? Because time decay, the theta component of this vertical spread, works faster the closer we get to expiration. So shorter expiration, faster theta, gets to that maximum theoretical gain, gets to this vertical spread being cheaper faster. So we want to have greater theta sensitivity in this discussion. And the longer time gives us, as Brent answers, more time for the price of the stock to do something we don't want it to do, right? So DJ says the next level of resistance is only about $1 away. I'm not really concerned about that, because I don't need directional movement. That's the difference between the long call vertical spread that we did earlier today and this short put vertical spread. That long call vertical requires directional movement. It needs the price of the stock to move, and it needs to move quickly to overcome time decay. In this particular case, I want time to decay as fast as it can, as quickly as possible, and quite honestly, I don't need the price of the stock to move at all. In fact, if the price of the stock were to come back down a little bit, that would be okay too, right? So that is something to pay attention to, right? And get to that point. So we don't need as much directional movement. Our gain is going to be less, but it's a higher probability trade. If I don't need to be absolutely correct in terms of time in the trade, price of the stock, then I have a higher probability of success. So this might be a little bit more probable from a success standpoint than that long vertical spread. So let's look at the two of them objectively compared one with the other, because I put the other trade on. So I have it here in terms of position. So I'm going to just show all, and I'll take my long stock position out, and we'll just do each one of these at one time. So I'll take the long stock position out. Let's take the trade that we're considering out. This is our long call vertical spread. Okay, and our expectation was upward movement in the price of the stock. We need the stock to move higher in order for us to get to that theoretical maximum gain. The stock's got to move all the way up here to 50 for us to get to that maximum theoretical gain. So it needs directional movement. Now, if I take that one off and I put the one that we just created on, you see how it moves back to the left? Meaning where the price of the stock is currently puts this trade already at that maximum theoretical gain, So thinking about it just in terms of the movement, that's one of the reasons why you might choose the short put vertical versus the long call vertical. And the other part of this equation is if implied volatility, we looked at VIX, right? If implied volatility goes down, implied volatility falling is going to benefit this trade. As a matter of fact, if we open up our price slices here, what I'm going to do is I'm going to set our price slices to base, to the current price of the stock. 48.27 is right there. We're going to open up our price slices, and we're going to look at this middle slice. So directionally, this isn't very sensitive, but theta is working for us. And if implied volatility rises, that's working against us. If implied volatility falls, that's working for us. Now let's change which trade we're displaying. Let's display our long vertical spread. Well, if implied volatility goes up, that Vega number could quickly overwhelm what we are gaining in terms of theta and what we're gaining in terms of directional movement. So much more directionally sensitive. Vega rising is going to work against us. In the long call vertical, Vega falling is going to work for us. Vega Rising is going to work for us in the long call vertical. Vega Rising is going to work against us in the short put vertical spread. So it's all about managing the sensitivities. And you can see that right here on the Analyze tab. And that's why I did it the way that I did it. Put the trade on earlier, and then now we're looking at the short put vertical. So what I'm going to do is I'm going to do this right here. I'm going to come down and we're going to confirm and send. This is our short put vertical spread. And I'm going to put it in the same group. We're going to put it in that vertical spreads group. And we're going to click on, we're going to read through the order again to catch the fact that, in that case, we had 2 instead of 1. I'm going to fire that order off. We'll see if that order fills. And it did. We brought in 83 cents. Now what we can do is we can come back over here to the monitor tab. And you can do this in your own portfolio, in your own paper money account. Now what I have, here's my long call vertical, and I can see its performance versus my versus my short put vertical spread, which really hasn't started working for me yet, but you can kind of see the comparison between those two. And if you are ever asking the question, right, between should I do a short vertical spread or a long vertical spread, this is a comparison that you can do. Put on the same vertical spread as a long call vertical versus a short put vertical, or a short call vertical versus a long put vertical, and compare the two, see how they work together. So there you go. Now you get to see the comparison of those two. So that's the one that we had. That was our Delta Airlines trade. The other one that we had on here was a long put vertical on FedEx. So what I'm going to do is I'm going to go to the charts tab once again. We're going to do FDX, FedEx. And the expectation here is that the price of the stock is going to move to the downside. Yes, both, Alan, so that you can compare the two for sure. Again, paper money is a great way to practice and learn. So here's my directional expectation. Price of the stock's running into this resistance right around the 220 mark. My directional expectation is that the price of the stock is going to move down. Implied volatility is already low or lower and still falling. We're past the earnings announcement. So implied volatility is still falling. That's going to help us if we create a short vertical spread. If that implied volatility were to rise, a long vertical spread might be better because that is going to benefit that long vertical spread. So let's see how we might put this trade together in comparison to what we did before. Here's the trade that we have on right now. We have a long put vertical, and we bought the 220 and we sold the 200, which means stock was at 200 when we put the trade on. We're expecting it to move down to 200. So let's put on an equivalent trade directionally. It's not going to be equivalent strike price wise, but we're going to put on an equivalent trade directionally. And we go back to the chart. Here's our resistance level. Old resistance becomes new support, right? So if this is running into that resistance level, we might see it bounce down and continue to be resistance. That means we're going to use this, what is now acting as resistance, as a locator for our strike price. We're going to sell our call vertical spread up here with the expectation that the price of the stock is going to go down. So let me just do this again so that we're consistent with what our expectation is. Trend direction that we expect is down, right? So we've already created a long put vertical. That has a bearish directional bias. Now, what we're going to do to take advantage of the same scenario is we're going to sell a short call vertical. Short call vertical. Directionally equivalent, different construction, different expectation. We expect the long put vertical to end up in the money at expiration, both strikes. We expect our short call vertical to be out of the money at expiration, both strikes, so that it expires worthless or it is really inexpensive to buy it back. Okay? So that's our directional analog and comparison there. So, yeah, I could. You're absolutely right, NK. Yeah, I could. But, then we'd have to wait to tomorrow to finish this discussion. So, I'm not terribly worried about whether or not this is going to make a directional move. And again, I'll tell you why, because that might also be another reason why we might choose a short put or short call vertical here, because we don't have to be as directionally sensitive. The long put vertical requires downward movement. The short call vertical, not going to be so much of a requirement here in this case. So let's go to the trade tab and let's create this trade for FedEx. Now, I could go longer or I could go shorter. In this case, I'm going to keep it exactly the same. We're going to go to the 30 May expiration. Okay. Now, where is my resistance level? Right? Where's my resistance level? Banging its head, the stock's banging its head into that 220. 220 with a big fat magic marker. It's currently sitting at 220.04. I'm going to call 220 my level of resistance. So I want to sell at or above that 220 level. If I sell it right at that 220, I'm selling the at the money strike, which has a lot of inflated implied volatility and extrinsic value in there. I'm going to be selling an expensive option. I'm going to get more premium. That's cool. But it also puts me in a situation where the price of the stock has to be more directional. So what I might do is I might back off of that level a little bit. You're absolutely right. I have a bearish vertical. I have a bearish long vertical on May 30. You're exactly right. Now we're creating a bearish short vertical. Thaya. We're using the call side to create a bearish short vertical. So I might go to the 225 strike and sell that 225 strike. Now the 225 strike is going to be right about here, right? It's going to be up from that resistance level a little bit. And we're going to go to the trade tab. We're going to sell the 225. And I'm going to buy the 230. We're going to create another $5 wide vertical spread. But this is a short put vertical, or excuse me, a short call vertical spread instead of a short, or instead of a long put vertical spread. Same expiration. I'm just doing these to compare side by side so that we can see it. So this is a short call vertical spread, directionally, again, the same bias as our long put vertical spread. I have a bearish bias. I'm expecting the stock to go down. Just want to be clear. Again, there's that feedback survey, guys. Fill that out. So $1.73 credit against a $5 wide vertical spread. This is a little bit better profitability than the one that we did on Delta, but same kind of thing. This is a highly probable trade. If we come back and we look at our option Greeks here, what's the probability that the price of the stock stays at or below our 225 strike? It's about a 40% probability that this is out of the money, or that it's in the money, which means that it's about a 60% probability of being in the money. Oh, excuse me, about a 60% probability of being out of the money at expiration, right? So again, a highly probable trade. So let's look at this in the Analyze tab. So what I'm going to do now that we've created this trade, I'm going to right click, I'm going to send it to the Analyze tab, and we're going to look at the two of these together. So I'm going to take my existing position off. We're going to look at the one that we just created. This is the one that we just created. This is our short call vertical spread. I'm going to set this to my expiration date, which is the 30th of May. I'm going to take this one off too, because I've got another one in there as well. And I'm going to set my slices to break even. There's my break even point, 226. So as long as the price of the stock moves and stays below that break even, I'm making some money in the trade or breaking even. If the price of the stock goes up above 226, so that's above my short strike. If the price of the stock goes up above 226, that's when I start to run into some loss in the trade. So I can be wrong and still make money. The stock can still go up a little bit and I can still make money in this trade. Now, the trade-off is I could be assigned early. I could end up having to take possession of the stock at my short strike, which is the 225 strike. Or excuse me, I could have to sell the stock at 225 and I have the right to buy the stock at 230. Okay. Obligation when I sell a call option is to sell the stock at that strike price. Right at the 230 strike is to buy the stock at 230. So I've defined my risk in the trade. So I could take a loss in this trade if the price of the stock were to make a big move to the upside, right? But my maximum theoretical loss comes at that 230 strike. If the price of the stock goes down a little, goes down a lot, stays where it is, or even comes up just a little bit, I'm okay in this trade because we sold this vertical spread out of the money. That means to get that higher probability of success, we're going to take a lower return on this trade. So let's do the comparison here really quickly. Here's our short call vertical spread. Let me take that off and let's put on our long call vertical spread. And you see the same thing here, right? Same expectation. It just has to have directional movement. It needs the price of the stock to move from where it is in order for that trade to become successful. Now, the passage of time is going to work against this trade, the long put vertical spread. But a rise in implied volatility is going to make that one more successful because it's going to increase the value of that option. Rising implied volatility is going to hurt the short call vertical that we created, but not by very much, because you look at that Vega sensitivity and it's not very big. Neither is the theta component, and it's not very directionally sensitive. It's not as directionally sensitive as our long call, or excuse me, our long put vertical, which is about double the directional sensitivity. It requires more movement in order for that trade to move in the direction that we want it to move. What if you apply the same strategy to shorter time frames? Absolutely, you can do the same thing. We've talked a lot about that. So what we've done now is we've done that comparison. I'm going to fire this order off really quickly. Before we go, I'm going to click on confirm and send. We're going to read through the order, make sure that this is what we want it to do. Now, make sure that you understand the characteristics of these trades before you do this, and do this comparison in paper money if you're going to do it. So we're going to fire that order off. We'll see if that trade fills for us so that we can do the comparison between those two and look at them side by side and see how they work. So it's verticals, it's calls and puts. I recall I really didn't know verticals at all. Now we've looked at verticals from both sides now. And let me give you some resources on how you can find out more information. Vertical spreads. If you come over here to the Trader Talks webcast page and you type in vertical spreads, now you get a whole bunch of webcasts that talk about vertical spreads. Selling 0DTE vertical spreads, long call verticals, short call verticals, short put verticals. You've got lots and lots and lots of resources to be able to do that comparison, to understand this strategy, and to take away from this discussion. So we have looked at verticals from both sides now. My thanks to Brent Morris for helping us out. My thanks to Bree for helping us to bring the production to you. And thanks to all of you for being here and answering those questions. Go ahead and click on that feedback survey and fill that out. Let us know that you liked this webcast by clicking on that like button down at the bottom of the page, clicking on the subscribe button if you haven't done so already. Follow me on X at Ben Watson CS. Follow Brent Morris on X at Brent Morris CS. And I'll see some of you later this afternoon in our last session, last regular session of our Advanced Options virtual workshop. Take care, everybody. Bye-bye.